Hi there. In this video, we will continue the discussion of the consolidation of the financial statements. Just to give you a brief recap of what we have discussed in the previous chapter, that we said a parent company can buy 100% of the subsidiary company and can give cash or stock and get full control share. And the main concept we have it in the previous chapter that the par value or the book value of the item given to the company is equal to the fair market value. So in this case, we have no goodwill or bargain purchase. But in this chapter, we will say the company will buy a percentage less than 100, but above 50%. And this one we call it partially owned. So with this in mind, let us take a look on the slides. So in the previous chapter, we have a company fully owned, we call it fully owned 100%, where the book value equal to the fair market value. In this chapter, we will talk about ownership higher than 50%, but lower than 100%, and we call it partially owned. In the previous chapter, since we have 100% owned, there is no non-controlling interest. We call it NCI, non-controlling interest. But here, since we have partial ownership, we will see a new account, we call it non-controlling interest. So how we handle non-controlling interest, there are two ways to do it. One, we call it proportional consolidation, and this is not in compliance with the US GAAP, but the full consolidation is the one which is required. So here the percentage of the consolidation less than 100%, but full consolidation, it's 100%. It means we consolidate the income statement, the retained earnings, and the balance sheet. So when I say 100% full consolidation, it means we consolidate all the financial statements. Here we report the NCI under proportional consolidation, we don't. But under full consolidation, we put the NCI in every statement. As the proportional in compliance with the US GAAP, no, and this is the reason I'm not going to discuss it in this chapter, but the full consolidation is required. And finally, the full consolidation, it is hard. This is the reason we spend several chapters and we take several examples to understand how we can make full consolidation. So let us have two quick examples and three exercises in this lecture. The first one, it says a company owned 80% from another company. The Peerless, which is the parent company, paid cash $240,000 and get ownership of 80%. But the good thing that the book value is equal to the par value, which means there is no goodwill and no bargain purchase. And here we have the subsidiary company, which is a special food company, has common stock of 200,000 and retained earnings 100,000. So the total equity of the subsidiary 300, and the parent company owned 80%. 80% times 300,000 equals 240, which is here. So if I have the total equity 300 and the ownership by the parent 240, now we see a new account called NCI for 60,000. And here we see the fair value of the consolidation 240, the NCI 60 are equal to the shareholders' equity of the subsidiary. And we make the journal for the investment as we did in the previous chapters. We debit investment in special food and credit cash. Of course, if we give other item apart from cash like bonds or preferred stock or common stock, we put it in the credit side. Now, how we close the accounts? So we split first the shareholders' equity between the parent and the subsidiary, and then we make this journal. So if you remember in the previous lectures, we talk about to consolidate the financial statements, we take the assets of the parent and the subsidiary, we take the liabilities of the parent and the subsidiary, but we take only the shareholders' equity of the parent. And here we close off the shareholders' equity of the subsidiary. So common stock and retained earnings for the subsidiary account were credit, I make them debit. Investment in the previous slide, it was debit, I make it credit. And then I create non-controlling interest in net assets of a special. And then we take it from here, we close also the depreciation, we debit accumulated depreciation credit building, and we put them here. What do we call this report? It's the worksheet that reflects all the changes that happen during the time of the consolidation. And here we see the closing for the equity accounts, and then we see the closing for the accumulated depreciation. Remember two things. Number one, when you do the consolidation entry, if you tally or add all the two sides, debit and credit, they must be equal. So here you see 300, and here you see also 300. I mean, you see 300 debit and 300 credit, 600. And here 540 credit and 60 credit, we get 600. So we have the two sides balanced. Why I highlight this point? Because if these two sides are not balanced, the balance sheet will not be equal. Number two, that when you close, you see here the investment account end up to be 0. And you see here the balance sheet, two sides are equal. Remember those two things, that when you close, the two sides must be total equal, and the two sides of the balance sheet will be equal. Now let us go for a bigger example where we can make consolidation in the income statement, retained earnings, and balance sheet. So here you see the income statement, retained earning, and balance sheet, and the ownership here is 90%. So please remember in every example to identify the ownership percentage. Anything between 51% and 100%, we call it controlling. So you might see examples where I put 75 or 80, 65. As long as it's above 50%, it should be controlled. We need to do the journal entries and the consolidation. So first, we need to consolidate the account of the retained earnings. And here we see the common stock of the subsidiary company 60 and the retained earnings 96. From where I get them, here they are. You can see here 60,000 common stock, 96 retained earnings. And then we divide them between 60 and 72 for the common stock and retained for the parent company. And then the rest will go for the NCI. And we also distribute the net income between the parent and the NCI and the dividends. And then we make the journal entry. As we did in the previous example, common stock and retained earnings, they go in the debit. Investment and NCI, they go on the credit. But why this journal is bigger than the previous example? Because here I start closing all the accounts of the retained earnings. In the previous example, I had one final ending balance for retained earnings. But here you see retained earnings, BB, which is beginning balance. And then we take the income from the retained earnings and the net income for the NCI, and we put the dividends. Why I do that? Because I am closing all the accounts of the retained earnings, which we didn't have in the previous example. And then we close also the depreciation account. And now we need to put the worksheet. So remember here, we take all these numbers from the journal entries, and then we add up to get the two sides equal. By the way, this example is mentioned in the publisher presentation, which is on Brightspace, so you can go through it in details. If the numbers are so small, or if you would like to trace any number, also you can hold my video here, go through the numbers to make sure that you understand how to do consolidation for income statement, retained earnings, and balance sheet. Now let us make exercises on Excel sheet where you see the numbers there. I put the Excel sheet on Brightspace, and you can follow up the exercises with me here. And here is the first exercise. There is a company, Platts, purchased 75%. Let me make it bigger. Okay. So the company purchased 75% for the cash, 95,250. And before I continue through the examples, you will see 3 examples in this video. The first one, the company is paying cash. The second one, the company is paying bonds payable. The third one, the company is paying preferred stock. So here we see cash is paid. And the good thing, the par value of the cash is usually equal to the fair market value. The cash doesn't have 2 values as we can get in other assets. And here we have a very simple balance sheet. So this can tell you that this one, we are not going to have the comprehensive consolidation, but only balance sheet consolidation. What are the requirements? First, we need to make the journal for the investment. Second, we need to compute the non-controlling interest. Finally, we need to do the worksheet. I encourage you to hold up my video and take a minute. Try to write down the journal and the calculation assigned, and then resume my video. Now, here is the journal. For the investment, we debit investment in Slicer, which is the subsidiary company, credit cash. And we don't have any issue because it's the same amount. And then we make the calculation here for non-controlling interest. We get common stock 63, retained earnings 64, minus ownership 95. We get NCI 31,750. From where I get 63 and 64, I got them from here. Here, 63 and 64. So those are the equity side of the subside. And now you can jump to the second part, and here you will see the consolidation. Remember one thing here, that the cash was 240 in the parent, but when you come here, you see the cash is not 240, 214. If you add up 100, if you add up 118 and 95, you should be able to get 214. So what I need to say is, out of the 214, the parent company took 95, 250 to invest in the subsidiary company. And then we have the accounts here. We add them together. And remember the consolidation entries, they must be equal. And then you add up the accounts, you get the consolidated balance sheet. As you can see here, they are equal. And remember, the investment will end up to be 0. The equity accounts of the subsidiary will disappear. So 63 and 64, they will offset each other. So we end by the equity company of the parent, and then a new account called NCI. So remember, this is the key difference between chapter 2 and 3. And in chapter 3 here, we see this new account which didn't exist in chapter 2 because we were talking about ownership of 100%. Now, let us do the same. Here is another example where you can see a company is investing in another company, taking 80% ownership, but here we issue, as you can see them here, bonds payable. If you can see here, issuing bonds. And here, the par value of the bond, 75,300, but the fair value, 92,800. What does it tell? It says the market value is higher than the book value. If the market higher than book value, we create premium on bonds payable. If the market lower than the par value, we create discount on bonds payable. The premium looks like a gain, and we put it credit. The discount looks like a loss, and we put it debit. Again, I encourage you to make the 3 things: the journal entry, the calculation for NCI, and then make the worksheet. Please hold up my video here, do your work, and then come back. And here the journal entry, we debit investment in Salami, but we don't credit cash here. We credit bonds payable by the par value. And the difference between the debit and the credit is the premium. So remember, the premium or the discount will not be given to you. You need to calculate it. And then we calculate here common stock, retained earnings minus ownership. We take this ownership, 92, we put it here. And then we get NCI 23. And once we finish, we take these numbers to the second sheet where we make the consolidated balance sheet. So as I did in the previous example here, you notice that the cash didn't change. The investment became zero. The equity side came only from the parent. So we offset the equity here of the subsidiary. And then we created the new account of NCI. The last example, which is for a company issuing preferred stock. And here the company purchased 80% by issuing 12,000 shares. The par value per share is $6. The fair market value 7.6. If the fair market value of the share is higher than the book value, we put it additional paid-in capital in the credit side. If it's lower, we put it also in additional paid-in capital in the debit side. So now we need to do the initial acquisition. We say debit investment in STL, credit preferred stock. Here we put the fair market value, and here we put the par value. The difference between them, it's additional paid-in capital in excess of preferred stock. And then we calculate here the NCI. We get common stock, retained earnings minus investment. We get NCI. Once we finish here, we go to the worksheet and then complete the worksheet. Again, similar to what we did before, we add them up here and we find that the investment is zero. The common stock and the equity of the subsidiary will be offset. And then we see here that the NCI is created, and that's so. Remember here, when we acquire a percentage of ownership above 51 but lower than 100, we call it partial control, and we create NCI, and for that reason we can pay cash or bonds payable or preferred stock. I will continue talking about the comprehensive consolidation in the coming video where we can have bigger examples that will cover the acquisition date, also cover the first year after acquisition and the second year after acquisition. I hope you find this video useful, and if you need any help, please reach out. Thank you. Bye-bye.